In the next 6 minutes, you are going to build a perfectly balanced Class XII partnership accounting problem from scratch. By the end of this exercise, you will know exactly how to map partnership profits into both fixed and fluctuating capital accounts, and you will understand the exact mechanical differences between the two without mixing up their rules. To execute this protocol, you need your physical tools ready. Grab a blank notebook, a calculator, a steel ruler, and a pen. Mastering this specific ledger setup from Step 1 is the only way to prevent a single calculation error from cascading through the rest of a high-stakes exam problem. Step 1 is interrogating the partnership deed. Exam questions are packed with narrative text, so we must filter out the noise and extract only the actionable financial data. Looking at this word problem on screen, we need to scan for 3 specific variables: the profit-sharing ratio, the initial capital investment amounts, and the agreed-upon interest rates. But look closely at our extracted list. There is a deliberate omission. The problem mentions Partner A's commission, but it says absolutely nothing about a salary for Partner B. When a partnership deed is silent on a specific term, we default to the Indian Partnership Act of 1932. This legal failsafe dictates that if no salary is explicitly stated in the deed, 0 salary is awarded. Furthermore, if the profit-sharing ratio isn't defined, profits must be shared equally, or 1-to-1. Identifying what is missing from a partnership deed is just as critical as reading what is written down. Missing this step guarantees an incorrect final balance. Step 2 is building the profit and loss appropriation account. This specific ledger is the central hub where the firm's raw net profit is adjusted and prepared for distribution to the partners. This graphic shows a blank T account for our P&L appropriation. We start by taking the firm's net profit and transferring it exclusively to the top of the right-hand column, the credit side. Next, we calculate the firm's expenses paid to the partners, the interest on capital, and the partner commission. Because these reduce the firm's overall distributable profit, we post these deductions sequentially on the left-hand column, the debit side. To determine exactly how much cash is remaining for the partners, we subtract the total debits we just listed from our starting credit balance. The result is our final divisible profit. We then distribute that remaining profit according to the 1-to-1 ratio we locked in during the previous step. Achieving a perfectly balanced profit and loss appropriation account provides definitive mathematical proof that all the partnership rules have been satisfied. Step 3 maps those distributed profits to the individual partners. We will start with the fluctuating capital account. This is the default, all-inclusive ledger that tracks a partner's total net worth within the firm. Looking at this new fluctuating capital account layout, we establish the opening balance by placing the initial investment on the credit side. Now we map all the partners' earnings, the interest, the commission, and the profit share, directly from our P&L account over to the capital account's credit side. If the partner withdrew any money for personal use, known as drawings, we deduct that amount by isolating it on the debit side. Finally, we subtract the debits from the credits to calculate the final, updated closing balance for the partner. This single account is named fluctuating precisely because its bottom line wildly shifts by absorbing every single day-to-day transaction. Now, let's solve the exact same financial scenario, but applying the fixed capital method instead. The core logic of the fixed method is protection. It creates a strict firewall between a partner's permanent investments and their volatile daily transactions. To execute this, we take that all-in-one ledger we just built and split it completely in half. We now have 2 specialized ledgers, a capital account on top, which acts like a vault, and a current account on the bottom, which acts like an active wallet. We isolate the original unchanging capital amount exclusively inside the top capital account, locking it away. All the remaining operational items, the distributed profits, the salary, and the personal drawings, are transferred down into the active current account. The capital account maintains a static balance year after year, contrasting sharply against the hyperactive balance of the current account. The fixed method protects the historical integrity of the initial investment by quarantining all financial volatility into a secondary ledger. You have just successfully applied the rules of the 1932 Act to extract data, allocate profits, and balance real ledgers. Looking at this summary, remember the core architectural rule. The fluctuating method requires only one account. The fixed method requires 2. capital, and current. Pause the video now and test your new framework against the rapid-fire multiple-choice questions appearing on your screen. Establishing this foundational mastery of capital accounts is a mandatory stepping stone. You will need this precise logical framework intact to survive our next highly complex topic, the valuation of goodwill.